This is the September Roundtable. Welcome, Knights. Let's get started.
All right, thanks, Ken. I guess I'll take it for the first couple of minutes here. Welcome, everybody, to the September edition of the Roundtable. Again, I'm joined here by Ken Kavula, Cy Lynch, Hugh McManus, and I'm Mark Robertson, and we've been doing this for a little over a couple of years, so we'll just kind of get right into the program. Again, if you have any questions or more information about future sessions, Ken, I'm getting quite a bit of feedback, probably from Cy. Might want to watch that to see if we're getting some feedback on his setup.
Okay.
Hopefully it's not me.
He's muted right now, so we're all set.
Okay. And again, welcome, and let's go ahead and get into it. Let's get the housekeeping out of the way first. We're going to talk about real companies in real time. No investment recommendation whatsoever is intended. This is all about demonstration and illustration of the philosophy and analysis process put into place by the modern investment club movement, something that we endorse at Manifest Investing, and basically follow the principles promulgated by George Nicholson and the modern investment club movement at NAIC Better Investing. So again, the moral of the story is please, please, please always do your own homework. Again, kind of that overriding theme that we really believe in community-based investing, that we all do get better by comparing notes and leaning on each other. And in my case, our group average performance is stronger because other people are involved with me and pulling me up with them. So let's make each other better doing this stuff. If you're new to this, welcome. We give you one great big hug and say welcome. Hope you'll come back and attend a few more sessions. We do this, as Ken was saying, towards the end of every month. For those of you returning, you get an equally big hug. Welcome back. Here's our standing agenda. We'll take a look at results for a few minutes. Ken's going to take a quick look at one of his favorite sources of ideas, kind of a list thing, and then we'll go into our stock selections. Cy would like to take a look at NSR, Neustar. Hugh McManus, in his own incomparable manner of approaching these things, is once again going to say he can't find anything to buy, so he's going to pass. Ken's going to cover credit acceptance, CACC is the ticker symbol, and then I'll close out things with IQNT, Inteliquent, the company formerly known as Neutral Tandem, and then we may or may not have an audience poll depending on timing and that sort of thing, but we do very frequently have audience polls. We keep track of everything that comes across the transom here. Just as a quick introduction to what we're talking about here, what we really do try to do, and this is what he was saying, he can't find a single favorite investment opportunity tonight, but on a monthly basis, we do try to identify a compelling, something that we're interested in exploring with the audience, and we don't do this willy-nilly. We really do want to be identifying opportunities, and again, it could be the four of us or any of our guest damsels or guest knights. We keep track of the collective performance of all the selections made, including audience selections, and we want to see the long-term return, relative return, be 5 percentage points better than the Wilshire 5000, and we track this on a continuous basis. We also would like to be accurate. And the definition of accuracy is simply outperforming the total stock market over a mirroring or a matching period of holding period. We want to do that, roughly 3 out of 5 selections in that 60 to 70% frequency time frame. So again, just launching into a look at where we've been and what we're doing. Again, every time we look at this chart, we say, thank goodness that the early years are behind us. The trend here is actually pretty good. We hope that we do march up to this 5% level. This 5% level is the objective shown here by this dotted line. That is actually a fairly common objective for investment clubs, to outperform a benchmark by 5 percentage points over the lifetime of the effort. And in this case, you can see that we are headed in the right direction, a little bit better than a month ago, and hopefully continuing to head north on that graphic. We're a little bit short of our 60% goal, but again, pretty comfortable with the fact that we're in here at 54%. And there's a lot of them that are very close to toggling to the right side of that equation. So again, really no concerns. We like the trend, and let's hope that in months ahead we do continue to drift up in the long-term returns. Okay, so with that, let's go ahead and talk very quickly about the companies that have influenced those results over the years. This is the tracking portfolio that you can find at manifestinvesting.com. It's a public tracking portfolio where we take and invest $1,000 into every idea brought to the table. Again, whether it comes from the knights, the guest damsels, or the audience itself. And you do have to kind of decode this a little bit. That's what this section down here at the bottom is. In the case of Walgreen, for example, up here at the top of the chart, it's actually been featured 7 times. So it's been selected by one of us or the audience 7 times. So a total of $7,000 invested into Walgreen is now worth $12,661. So it's actually had a pretty solid performance. And I think, if I'm not mistaken, every single one of us has selected it at least once, and he was selected it a few times. So again, that's the way you decode this chart. And again, it's continuously available at as the roundtable tracking portfolio on our homepage. But again, there's some selections here that have done quite well. Staples, Cognizant is a community favorite. This performed very well. Aflac, we were all over Aflac when it dropped in price several months ago. And in fact, just looking down here, Aflac has been selected 4 times. So $4,000 has become $6,250 in fairly short order. So that's up quite handsomely. One night, Ken and I both picked Fossil. And then I believe the audience tripled down on our selection, so we're actually doing very well on that selection. So again, these are companies that can often be community favorites. By the same token, we like to bring companies that might be a little bit new to the mix. For example, down here, this is one of Ken's favorites that he selected some time ago. NIC is the name of the company, and the ticker symbol is eGov, E-G-O-V. Ken, you want to share a couple words on that? Or?
Sure. These folks help states set up portals so that when you want to use the internet to renew your driver's license or your hunting license or maybe make a contribution to the parks, the state sets up a portal where you can use the internet. And eGov has these portals working. They have state contracts with over 40 states. They're working to be the provider of these portals nationwide for all the states. And they have a pretty nifty business model. It's a pretty interesting company to take a look at. Nice SSG, by the way.
Yeah, it might be a little bit pricey now. We say that because the projected annual return is down a little bit south of 10%, but again, just be patient and wait for that opportunity. Any other comments or questions on the highlights of the portfolio?
No, this is a quiet audience tonight, Mark. We're not asking questions. We're not raising hands or anything. So
we'll have to see if we can't get them revved up a little bit. Well,
right.
Here, I'll walk us through here real quick. You know, this is our report card, the portfolio report card. So again, we're not obsessing over the portfolio, but we are keeping track of how well we do, and we do want to outperform the market over the long term. In order to do that, we think it's prudent and necessary to keep track of, well, what is the average stock? Well, today it's about 6%. This stands for Manifest Investing projected annual return. It's the average return, actually median return, for about 2,500 companies, and that's updated daily. So in order to outperform that, obviously we have to tack on a few percentage points to that. We would love to be in the 11 to 16% range on the overall return forecast for the portfolio. And you can see down here, we're just a little bit, tiny bit short. We'd like for that to be 11. Well, I think we'll get there tonight with some of the companies we add to the portfolio. The 3 most important characteristics for any portfolio design, we believe, are the return forecast, the quality, which is exceptional. Again, our community has no difficulty identifying the best of the best, leaders within their industry. So again, the fact that this is in the upper quintile of excellent companies is no surprise. And then we also know that it's extremely important to identify, explore, and select enough small and medium-sized companies to keep this growth target somewhere in that 10 to 12, call it 11% or so range. And again, we'd like to see it give or take 11%, the average sales growth for the portfolio, to be somewhere in that range, maybe a little bit higher, maybe a little bit lower. But again, just to make sure that we're selecting from faster growing small companies to blend in and balance with our larger, slower growing companies, the blue chippers. And then just some other characteristics here to make sure that the selections aren't too out of whack. The PE is fairly conventional, pretty close to market average. Again, a fairly conventional yield. Financial strength, that's basically an A financial strength if you translated that to a value line rating, so that's just fine. In the earnings per share stability, all we do is take a look at the bounciness or the roller coaster of the trend analysis for earnings for all the companies. And in this case, we're looking at a 78 for earnings per share stability, again suggesting pretty solid and reliable, consistent long-term trends. Here's a quick look at the companies in the portfolio, the tracking portfolio that would have the lowest return forecasts. Only ones that are listed are those that are less than the 6% return forecast for the average right now tonight. And again, we wouldn't get too concerned about any of these that are in that 5 range because it's very close to market returns. Maybe a little bit more concerned about the ones towards the bottom, and the one that we could kick around if we get some time and you guys want to is AeroVironment. The recent update to the fundamentals at AeroVironment that we did at Manifest a couple of weeks ago, it's featured in our cover story this month, suggests that the company is headed for some real, well, dare I say, substantial turbulence. And it's a company that really does look like it's been shaken up a little bit and could be facing some tough challenges ahead. Just something you might want to crank through and see what you believe about the company. Any thoughts on the companies that maybe are the most challengeable in the portfolio, guys?
Well, I was talking with you about AeroVironment earlier this evening, Mark, and I did make the comment that it was one of the kind of small speculative companies that a lot of times I placed in my portfolio more for what it could do in the future rather than what it's doing right at the moment. And as it represents such a tiny piece of the portfolio, we don't need to fool around with it too much. I might just try to put it away and play Warren Buffett for just 30 seconds and not think about it for the next 3 to 5 years. Pull it out then and see what's been going on with it.
You know, this is one I'd kind of like to see if Hugh has a comment, because a few months ago, you guys might remember this company showed up at the bottom of one of his bottom fishing shopping lists, and at the time he said, no, I think I'd rather stay away and wait for that price to get much, much lower.
Yeah, I'm still waiting. So if you yank it out, I'll probably be putting it back in again. We can do a little bit of a French farce here with AeroVironment. You can sell it to me at a much lower price. I'm open to that.
Okay.
That's a win-win.
What will you be watching? When will you know when the price has dropped enough for you?
Well, I mean, to try to avoid accidental puns here with a company like AeroVironment, but it will continue to sink if the news is bad, and particularly because a reasonable percentage of its top line is dependent on the federal government, and the federal government is in budget tightening mode at the moment. But the FAA is opening up the airspace for drones. They reckon that there will be tens of thousands of them in the air. Of course, this is all speculative, but at least there's the potential for 30 or 40,000 of them flying around the U.S. doing all kinds of things, monitoring traffic, forest fires. Your local tiny community might have one for traffic surveillance, this kind of thing. I imagine, and inevitably with this type of technology, they'll find applications for it that they hadn't even thought of. But I think it's a company that, if it's managed correctly, has a potential for success.
Yeah, there is actually another aspect to their business. They're into recharger stations for automobiles.
That's the other thing.
Electric,
really.
I mean, they've got some other stuff too, so could be interesting. Anyhow, I just thought I know that you were also talking a little bit about watching inventory issues at the company and that kind of thing.
Yeah.
So maybe that's something we could dig into in a little bit more detail some other time. We don't really need to. You know, Ken always points this out. We don't need to take any action here. The portfolio average is right around 11%, so we don't have to do anything really, other than identify some companies that we can hold our nose and go for them here tonight. Any comments, Cy?
Well, the only, I guess I would make two conceptual or abstract comments, not necessarily specifically on AeroVironment, but it's a good example. I'll start with your latter comment that we don't need to do a whole lot with it because of the portfolio par, which I agree with in general when you're talking about core holdings. My question would be, is AeroVironment a core holding? And if so, if not, I would say approaching 0% projected return is a good reason, regardless of what portfolio par is, to strongly consider selling a non-core holding, as opposed to a core. Sure. I would agree 100% with your statement. The other thing, and I don't always do it, but I usually end up kicking myself after, is taking a look at the chronicle on the company. And AeroVironment has basically a flat price with declining quality and declining total return. If they had declining price too, which is when normally you would expect potential return to be going up, that I have found to be pretty strong sell signals because the company's deteriorating. Now, all of that said, AeroVironment is a pretty speculative company for all the reasons y'all have been throwing out, and a small percentage of your portfolio, it would make sense to sell. I mean to hold and just see if it pans out over the long term. But my comments, are more general. That if you're looking at non-core holding close to zero, you want to be looking at potentially selling. And same thing, when your quality's down right there in the 50s and your returns going down, that's usually a pretty good sell signal.
And Cy, I'd agree with you. If that par drops any more, beneath what my par is, I'd agree that it's time to get rid of not only AeroVironment, but maybe 3 or 4 of these off the bottom to boost the par. I'm a little bit eager to boost the sales growth number as well. At 10.4, it's acceptable, but I'd rather see the sales growth number up around 11, even maybe 11 and a quarter, 11 and a half even.
Absolutely. So let's go ahead and table this one tonight. As I said, we covered AeroVironment in our cover story this month, so it might be worth digging into, especially if you're in a club that either follows it or owns it. And we'd love to hear what you decide to do with it. So with that, let's go ahead and get into our stocks. Cy wants to bring Neustar, ticker symbol NSR, and I think it's pretty obvious why he's bringing it. So take it away, Cy.
All right, thank you, Mark, and good evening, everybody. Here is Neustar. They are a telecommunications, primarily at this point in time, telecommunications technology systems company. They are seeking to expand some of their technologies outside of the telecommunications sector, both with an acquisition that they made about 1.5 years ago, as well as leveraging. What the company started out doing was managing the necessary databases to allow telephone companies to implement the federal requirement for portability of phone numbers. And that still is the majority of their revenue is derived from the contract that they have for portability of telephone numbers. And in fact, that is their communications or carrier services division. They have 3 operating segments: carrier services, which again is primarily this portability number, as well as keeping track of area codes and the like for routing of phone calls and for caller IDs and that sort of thing, services for the carriers. Then they have enterprise services, which is their second operating segment, and that is largely services to internet-related companies. And one of the big things that they do is maintain the .biz and .us upper-level domains. and that's under a contract as well with the. I'm sorry, it's slipping my mind who manages that, but the quasi-governmental entity that doles out the domain contracts. They do the .biz and the .us contracts. And then the third area, which is their fastest growth area, and what they are hoping to expand most in the future, is their information services division, which they provide all sorts of things like marketing analytics, lead verification, online advertising, search options, and the like for businesses outside of the communications and internet businesses, which the first two are primarily communications related. This information services, which they acquired a company called Targus Info, and they have shifted some of their own assets into that division. That's the division where they hope to expand out of just the communication area. And in fact, last year was the first year that more than half of their revenues came from other than this phone number portability contract. So let's go ahead and move to the next slide, and I'll show you where Neustar came up. I just decided I would go over to Manifest Investing, click on the Stocks tab that you see circled at the top, and this is the screen that pops up. It's a sweet spot screen that gives you basically all the companies that fall in the MyPar plus 5% and less than 10%, the green companies with a quality rating, I believe financial strength rating of 80 or higher, isn't it, Mark? I think that's what this screen today, I replicated it doing.
Yeah, that's the ones that are going to most often show up, Si, yeah.
Right. Yeah, I know there's a few more things in there, but this is the screen that popped up. Neustar, as you can see, is the fifth on that list, and so it was a company I wasn't familiar with, and I said, let's take a little bit closer look. So I do what I frequently do, and do a mini industry study. I clicked on the Technology Information Services link, and it comes up ranked by par, which is the top screen that you see, and you see Neustar is the has the highest par in the industry. And then I clicked on the quality to see who the best in breed, the top quality companies are, and as you can see, it ranks third. And again, there's not tons of difference between the 93 that you see of Moody's and 100 that FleetCor is. Those are all super excellent companies. But Neustar, again, caught my eye. So I decided to dig a little bit deeper into projections, and took a look at the history as well as what Value Line said about the company, and what Manifest had on the company. Manifest, I think right now, is projecting sales growth of about 13.5%. Value Line is projecting in the 8.5% to 9% range for sales growth, which I just didn't see any real logic to. I ended up settling on 12%, and where I got the 12% was that in the last couple of years, their two more stable and older, slower growing divisions, that being the carrier services and the enterprise services, which right now is the majority of their revenues, grew at about 12%. So I felt that was a fairly sustainable growth rate, with them projecting the information services sector to grow much faster, as it has, but it right now is less than 20% of the revenues, but that will be changing. As far as the net margin, I took roughly the current margin for the current quarter. You see the trailing margin is a little lower at 17.3, and I think this is in line with the Value Line projection for margin as well. PE forecast 19 looked pretty solid to me. I think Value Line may be carrying it at 20. I believe Manifest is 19, which is kind of where it came from. I just felt that was reasonable. And applying all of that gives me a projected annual return of 12.4%, which for a new company in the portfolio I thought was good. Also, it gives us a little bit of additional sales growth to boost that sales growth that Ken was talking about, although again, just being an initial position, it's not going to budge a whole lot, but it's going to move us in the right general direction. The one caution that I will throw out that you need to be aware of with the company is that the contract for the carrier, for the portability of telephone numbers, that expires in 2014, I believe. I was just trying to check my notes to verify that. Well, I cannot find it, but I won't hold you up. Just make sure to check that. I believe it's 2014 is when that contract is being renewed. And of course, should they lose that contract, then obviously they will take a pretty big hit on revenues, which is one of their reasons for diversifying. But they have been monitoring their client satisfaction and have been getting excellent ratings, so they feel, the company feels very confident that they will be able to have that contract renewed. So that's my pick.
Thanks, Si. They can only hold off GoDaddy, huh?
That's right.
All right, so let's switch gears and give Hugh a chance to talk about why he chooses to pass this month. Is Hugh still with us, or is he walking in the surf in San Diego?
No, I'm still here. I just forgot I had muted myself.
All right, I figured you had your toes in the surf.
No, I can see it from here, make you jealous. It's quite beautiful. But I'm not much of a beach person. Well, it's interesting, you know, I track these things on a spreadsheet. I use Quicken. There's a lot of companies that I download prices from, look at their 52-week high and low, and I'm cheap. I like to buy things when they're near or as close to as possible a year low or multi-year low, and right now it's very hard to find such companies. Ameren was a company that came close. It's a company in the pharmaceutical, biotech, emerging pharma area, but there's a little bit of risk associated with that company, but that's fine. If you can control risk and buy at a low price, or at least understand the risk that you're buying into, then you can realize an average return. But you can see here that the Value Line total return forecast is down near a low, and I always get nervous when that happens. Mark kind of put the slide together, and actually it's part of the standard presentation that we give here every week. And just it seems that companies are pretty fully priced right now. It's not to say that I won't be wrong. I mean, it's always the case that a company that looks to be way overvalued is actually at a 52-week low, and it's at the first week of those 52 weeks, but you just don't know it based on looking back. And that's always the risk. But I just know from experience early on in investing, almost 20 years ago now at this point, that many of the mistakes that I made were buying companies when they were too pricey, buying expensive companies, quality companies, but when they were expensive. And that's a painful lesson to learn, but it's a good lesson to learn, scratch your knees when you're starting off, because you swear you will never repeat it. And I might go to a bit of an extreme on this, because I've passed twice now and had participated last month and the month before, if travel hadn't allowed that. Chances are I would have passed on both those weeks as well, months as well. But one of them I was actually looking at Caterpillar yet again. But that poor old company is now quite fully valued as well. So I much rather have it when the Value Line total return forecast is well over 10 or 12%, and everyone's running screaming from the market saying now is the time to abandon it. But now we're hearing about even more money pouring into the market as people are getting out of bonds, tapering imminent, etc., and people are trying to move into investments that will show them a better return over the long haul. Equity seems to be the case. but as is often the case when equities returns look good, historically it's probably a time to ease off a little bit, or certainly be more selective in what you buy.
Yeah.
Unfortunately, I'm overly selective at the moment and can't find anything to buy that I like.
Yeah, you can certainly make a case that there's kind of some steroid type stuff going on, and when that stuff goes away, wow, you know, as long as the momentum hangs in there, the stuff is going to keep chugging. But
that's right.
You know, there's going to be an event that takes the momentum out, and sometimes that momentum can be sucked out of the market rather dramatically quickly.
Mm-hmm.
And that's kind of what, you know.
And you know, people have accused me of market timing. I brought this up a few years ago at a convention, and it would argue this is a little bit of market timing, and I guess to some extent you could argue that. Although I am looking at specific companies, but I just don't want to buy things when they're expensive. I'll give you a very good example. I was in Indianapolis at the American Chemical Society meeting a few weeks ago, and I like to buy white shirts for business, right? And I can't think of the brand name right now, but it'll come to me. You can walk into a Macy's or a Nordstrom's, and it's there. I was able to buy these shirts once, more than once, probably 4 or 5 times at different malls around the country for $24.99, and they're regularly $55 to $75. And I cannot get that price out of my head. So if I walk into a Nordstrom's or a Macy's and that shirt is selling for $26, I won't buy it because I got it for $25 once and I want it at that price again. And I will keep looking at Nordstrom's and Macy's until they sell me the shirt at the price I want. And invariably they will. It happens. And I buy a lot of it when it happens.
Yeah,
sometimes it might be, you know, penny wise, pound foolish, because I remember I bought so many clothes once that I had to buy a suitcase to ship them back. I actually didn't need a suitcase. I actually should have figured that into the cost basis, and maybe it would have been worth paying the extra $1 or $2 that they wanted when I've strolled into those stores in between business calls and there's nothing better to do. But I guess that's the way my mind works. I'm just a cheapskate.
Well,
I'm completely unapologetic about it.
You're full-on stubborn, man, and that'd be to be commended. Very disciplined, stubborn. All right.
Mark, I'm doing a little bit of ruminating here, Mark, and I'm looking back at this graph, and I'm asking myself what was going on in 2004 and again in 2005 when the value line was as historically low as it is today. Weren't we in the beginnings of a pretty decent bull market at that point?
Yeah, that's one of the points we do like to make, that, you know, if the fundamentals come along with the stock price, you know, all through that flat spot there, the fundamentals were improving, so it was kind of like in a holding pattern, you know, along that plateau down at the bottom or whatever you want to call it. You know, as the stock prices were going up here, you were getting corresponding, you know, improvements to the fundamentals, so at least it stayed relatively flat, up to the point where fundamentals could no longer keep up, and then you know, you basically had the bottom fall out of it at some point. But yeah, you know, one of the points that we do like to make is that when a market appears to be overpriced, be careful, because it can remain that way for an extremely long period of time. This certainly is quite a long period of time, but at the same time, we're as stubborn and disciplined and patient as Hugh. We say you still have to go out there and find stuff that is truly a bargain. You know, and all he's saying tonight is he can't find one that fits that description right now.
Okay,
I can't find one that I want to own for a long time.
Yeah.
And those numbers at 10% were achieved in 2 quarters. It looks to me like the average during that time period was closer to maybe 13, 14, maybe even 15%. Am I right?
As far as where now, Ken?
Well, in that period that you have marked with the brown line there, it looks to me like the average value line return over that entire period was somewhere maybe at 13 or 14%.
Oh no, you want to come over here. You want to come over here. It was in the, you know, again, probably more like the 6 to 7% range here. The returns are over here on the right-hand side.
Is that where the value line low total return scale is?
Yep, this is value line low total return. This stuff on this side is the Wilshire 5000.
Never mind.
But it makes the point. We're sitting, you know, this entire time frame, you were trading in a range somewhere in that 6%-ish, give or take. And it really was a matter of the fundamentals were keeping up until they no longer did.
Okay.
And of course,
I just had my numbers. I was just reading the wrong scale. That's all. Okay.
Yeah. Well,
Actually, back then, if you remember, that was around the time, it was right before the George Bush's re-election. And kudos actually to the Fed, because people forget this, they were actually inching up interest rates at that point.
Yes, yes.
Which put a bit of drag in the stock market as well.
Mm-hmm. Anyhow, the point is, this is, and in fact, what I think I will do is post in the featured articles at Manifest that dissertation by Mark Hulbert that he did a few months ago, because we're about ready to put another one of these, in the can with the quarter ending September 30th, and he does an entire dissertation on how he gets the heebie-jeebies every time you get down into these low single-digit return numbers, and it's maybe something to visit. Doesn't mean that you can't have the heebie-jeebies for a long time. But
the flip side of all of this is the world economy is still in the doldrums. I mean, if things turn around, and they only have to turn around global domestic product by 1 or 2 percentage points, even 1 percentage point, and things start to pick up again. I mean, if Brazil hit that critical mass and took off, China was a lot more predictable. Certainly, if the housing market there corrected itself in some fashion, or at least showed signs that it was headed in that direction. If we really start to see the dividends of all this oil and gas discovery in the U.S.
Yep, but that's
Mike is also reminding us that somewhere in here is the irrational exuberance we experienced as well.
Yeah,
that's a good point. Yeah,
towards the end of that, yeah, for sure.
Yeah, and just one thing that I will throw out, because I have been both as I age and looking more at becoming more capital preserving in mind at times and capital building. I'm interested in these things, and should I be taking the Hugh McManus I'll pass this month mode and perhaps even sell a few things, not get out of the market, but the arrows that you see going up there, we know from experience that even when, and as this chart shows, that the market can continue going up even after the heebie-jeebies signals start flashing. And we know that eventually the market will reach its peak and will come down. That has always happened. It will happen again. The question that I ponder sometimes is, okay, if we're getting 15% or so a year on the market, which is what you're doing right now, and hopefully you're going to get a little better if you're picking good quality companies at good values. If we're getting that, if it's going to continue for a couple of years, am I building up already enough that, for example, at 15% a year for 2 years, that's 30% non-compounded. So I can take a 20% drop in the market and still be ahead. And, if I had stopped, say, a year earlier, I'd be worse off than riding it out. Now, this chart, of course, you see because we had about a 50% drop, you do actually see that there for a couple of quarters there in 2009, the market did actually drop below where it was back in the, initial heebie-jeebie time. So, but realize that's about the second worst market drop we've seen since World War II.
That's right. Yeah, that's unusual.
Right. So that's the other side of all of this equation. If I could get out back in 2004, maybe, and hold, patiently hold for 3 or 4 years, I might be good. But really, am I not better off possibly just holding and riding the market till that peak in 2007 and go ahead and take a 30% hit?
Well, we certainly saw that with Tin Cup, the model portfolio, and I mean the rapid recovery of that by doing exactly what you're talking about. That's always 100% fully invested. So it certainly can be done by picking.
You might find, Si, as you continue to age, that the thought of leaving all of your money to somebody that didn't earn all of it begins to weigh heavily too, and you begin to find creative ways of spending a little bit of it as well.
That's a good way to phrase it.
Yeah, I like that idea,
Ken, I'm always willing to help you with that.
Yeah, I know. So is my son and my daughter. So.
All right, we better move on before we get in any trouble here. Speaking of money, let's switch gears and talk about credit acceptance, ticker symbol CACC.
Well, Mark, before we do that, Mark, I'd like to go to a list that was recently published and just bring it to folks' attention, if I could. I'm going real quickly, and can you throw the screen to me, Mark? You think?
Yeah, I think so. Let me see if I can do some gymnastics here. There you go, Ken.
And I'm going real quickly. You see an Internet Explorer page, and I'm typing in, just in my normal browser, fortune.com. This is free. This is available to all of you. So there's nobody in the room that shouldn't be able to get this. And right in the middle of the page, it says rankings. This list just came to me in print form less than a week ago. And what I do is I find this list to give me all kinds of ideas, enough to last for the next calendar year at least. Here it is, the 100 fastest growing companies, and I'm clicking on that. And as soon as it loads here, I'm showing you just a few at the very top of the list. Let me go back if I could, because somehow it scrolled out of it. Well, that's nice. I'm going through the list one by one here. I'm not going to take up much more time except to tell you that Jazz Pharmaceuticals is at the top of the list, and I've created a dashboard that is public, and that if you send me a note or send Mark a note, we'll send you back the slug which will allow you to access that public dashboard. And I've put all the companies that are followed by Manifest Investing on this dashboard, put $100 into each one of them on the day that I got the list in print, and we'll see how these companies do. But there's 100 of these companies for you to take a really nice look at. It's a free list. I would urge you to take advantage of it and see what you can do. One of my clubs is culminating a study of biopharmacy, biopharmacy, I guess is a good name for it. And Jazz and Questcor, number 1 and number 3 on the list, have risen to the top of the industry study. And we're going to be buying one of those two stocks in the next month or so. So take a look at it and see what you think. My stock for this evening is Credit Acceptance, CACC. And I'm showing you right now the home page of Credit Acceptance, and on the home page to start with is a little video up in the corner up here, and if you're trying to figure out what this company does, I would urge you to play the video. It's only about 45 seconds. We tried it before the session began, and we're having a difficult time making the sound come over the airwaves to everybody, but I'd urge you all to go to Credit Acceptance if you're interested in the company and play the video. What the company basically does is it provides auto loans to people that have credit problems, that have credit issues. Now, what they do is a little bit more complicated than just handing you some money. They come into contracts with dealers. And if you want to work with Credit Acceptance, you put your name into Credit Acceptance, and they will provide you the name with some dealers in your area that work with Credit Acceptance. You'll go to the dealer, you'll find a car that you like, and you'll sit with the dealer and you'll come to terms that are agreeable to the two of you. Credit Acceptance then gives the dealer a stipend for selling the car. and they give the dealer a little bit of profit on the front end of the deal, and then credit acceptance assumes the debt, assumes the loan. You actually pay your payments to Credit Acceptance Corporation. They have a pretty amazing rate of being successful with these high-risk loans. And for people that have terrible credit that aren't able to get a loan through a bank or a credit union, Credit Acceptance is one way to get a decent loan at an interest rate that's not so terrible that it's like putting it on a credit card. You will pay higher interest rates than you would through a bank or credit union, but at the same time, if you don't have any access to regular credit, this is one of the few ways that you can begin to reestablish a better credit rating for yourself. I love these lines on the SSG that I hope you're all seeing right now. Beautiful straight line for sales, and that's the line that I focus on more than anything else when I'm beginning a stock study. Remember that this debt right here includes an awful lot of loans, and they appear on the balance sheet as debt. So in one way, Credit Acceptance has some very similar ideas, very similar issues that banks have when it comes to examining their debt. You know, I love to visit clubs all through my area, and one of the biggest things that clubs always tell me is that they have a very difficult time finding good solid companies in the financial sector because they don't trust their analyzation of banks, they don't like to analyze banks, and there is nothing else to buy. And I like to pull out my portfolio of financial sector companies that aren't banks and show folks that there's a lot of fairly simple business models where you can sit down, understand where the money comes from and where it goes and how the company makes a profit, and at the same time do a pretty good analysis of what you think the profitability of the company is going to be. Credit Acceptance is one of those. One of our model clubs here in mid-Michigan is studying the credit services industry right now. I can tell you we've narrowed that industry to Credit Acceptance, Visa, MasterCard, First Cash Financial Services, and World Acceptance. We're in the middle of that study. I can tell you the results maybe 2 months from now, but we're looking at these companies because the business models are fairly easy for us to understand. I like the fact that there's good, solid, recent growth, and this growth has been going here in sales at about 14% for a fairly decent time. The historical growth has been at 17. There's been a little bit of slowing more recently, so I'm choosing 14 going forward. I did adjust the pre-tax profit margins. If you look at the historical numbers on pre-tax profit margins, you'll know that in the last 4 years they've been closer to 56, 57, even up to 60. So instead of using the 5-year average, the default, I am using 56% as a pre-tax profit margin, letting the income tax rate and the shares outstanding stay as defaults. And I'm getting this 14.4 going forward, estimated growth for future earnings. That certainly is in line with what it's been doing the last 3 or 4 years, so I'm reasonably comfortable with those numbers. Check out the profit that the company makes. They take a lot of risk with their customers, but they make a good profit. And check out the return on equity. It's just up in the stratosphere. Great return on equity numbers. Again, these debt numbers reflect the fact that people owe them money. They give out loans, and that appears as debt on the balance sheet. For PEs, I've moved to about 12 or 13 at the high side, 7 or 8 at the low side. I have adjusted for the last 4 quarters because it is a fast-growing company, and I'm getting a pretty good upside downside and about a 12% return. Let me show you that Manifest, and you know, I've closed Manifest out of my tray right here, but I will tell you that Manifest is at 12%. Let me go there real quickly just to show that without any problems. And I think that this is a company that certainly belongs in an industry study. I think you'll find some great other candidates in this industry as well. Here's that stock, CACC, Credit Acceptance. If you go to their webpage, I would urge you to read the letter from the president. Usually these letters are filled with platitudes and a bunch of indecipherable numbers. This president's letter is written in pretty simple English, and he explains how they take a risk, how they grade the risk that the person that's buying the loan presents, and then it tells you how well they do on the grading process. They've come up with some algorithms that really help nail on the head what's going to happen to these loans as they go through the 3, 4, 5 year loan period and how well they're going to perform for them. So it's a very, very interesting company, a lot of information available, and I would suggest that the growth rate up somewhere around 13, 14, 15% is the kind of growth rate we want to put right now into our portfolio so we can raise that growth rate like I spoke about before. Here's those companies in the credit services industry that I've mentioned that I think have a lot of potential in an industry study headed by Visa, MasterCard, Portfolio Recovery. This is Cash America, maybe not as high a quality company, but a little bit of return. If you want a company with a lot of its earnings offshore, Cash America might be for you. But I like CACC as part of an industry study. I'll tell you if we think it's the best in a couple of months, but for now, let's put it in this portfolio and see how it does.
Sounds good, Ken. You're aware that's a Southfield, Michigan company, right?
I am absolutely aware that that's a Michigan company. Whenever I can find Michigan for the home office, that's a plus in my book right now with what's happening in our state.
Yep. Anything for the home team. Okay, well, thanks, Ken. Let me go ahead and switch the presenter back to me. It is a compelling study. I mean, it's a group of companies you have to be careful with, but I think it's quite compelling. Let me go ahead and close out tonight. I see we've got a couple minutes here, and we should leave some time for questions and answers. Also, I'm going to feature Inteliquent tonight. The ticker symbol is IQNT, and many of you will know the company as the company formerly known as Neutral Tandem. And I'm going to start with just a little bit of a story here. About a few years ago, a friend called and suggested that I take a look at Select Comfort. At the time, the company had no long-term debt and a financial strength rating of B+, so in pretty good shape. And for those of you that don't know the rest of the story, I'll just jump to the punchline. Southern Comfort, there I go again. Select Comfort actually would drop down to a stock price, I believe, of like 20 cents, and has since recovered up to like $30 in a relatively short amount of time. And again, the moral of the story was, here's a company with no long-term debt, probably not really in danger of going bankrupt. They make mattresses, the number mattresses that you're familiar with. And my friend just basically posed the question, do you really think the last mattress has been sold? The company faces tremendous industry challenge and competition, but again, kind of put it in that context. Well, this is a company that's kind of in a related field to what Cy brought up. It's all about packets of information being taken care of for the internet and the telephone companies, etc. And what I've included for you here is one of those things that we suggest that all stewards, shareholders, and stock watchers for investment clubs include in their vigilance for any of the companies that they follow. And usually we're talking about the reverse of this picture, where the current estimates on a company are declining and deteriorating. But in this case, the company formerly known as Neutral Tandem is actually seeing a rather miraculous change to the upside, an improvement in the overall picture, both for the year ending 2013 and 2014. As it turns out, they were in a nasty investigation, the old accounting practice type stuff and a variety of different things, and they've been kind of cleared of all of those terrible issues that were facing the company. So now we're left with the challenge of trying to figure out what might this company return to. So yes, it is a turnaround situation. Yes, there's actually an elevated risk of doing this at a time when the average return is down so low. You typically would want to do this when the other side of the picture, but I think this is kind of a special case. Here's a look at the not so up straight and parallel situation at the company. They have had challenges, but again, as we're pointing out here, recently there's been fairly dramatic improvements, and in fact I think the improvements continue almost on a daily basis as more of the analysts who follow the company check in. And if we see these ratchet to the upside, both with sales expectations, as Ken was just talking about, and if profitability actually returns to any of those historical type levels, could be a very interesting situation. The company is already up several 100%, reflecting coming off of these lows down here. Here's a quick look at the equity analysis for the company. Again, we're talking about a relatively small company at $200 million in sales. I'm only using a 4% growth rate based on their history, and just trying to be very conservative with the situation. You can see that we're also using a net margin of 13.5. They've actually done better than that historically, but again, that's a bit of a maybe a little bit of conservatism compared to what they have done. Value Line, for example, has them at a future net profit margin of 13.7, but this is a company that has approached 20% in the past. The PE ratio, again, many of the people out there are looking at 18 to 20 being feasible, even if we only use 17. We basically generate a projected annual return that's over 10 percentage points above the market at a stock price of $8.43. By the way, the company did top out at a stock price of $34.60 back in 2009 when the investigation challenges started. So we're looking at this, it looks like a fairly interesting situation. I actually think that this growth forecast is probably low over the long term and could easily be 5-6% or more. It'd be kind of fascinating to see how this company falls into line. And I believe that this type of a number is worth pursuing as a turnaround. We may be looking at a situation where we almost put the Roman candle type protection in some future month, but for right now I think we'll just go ahead and get it in the portfolio. I thought what I might do is go ahead and take a quick look at the Value Line page, just so you get a feel for how drastic this situation has been while the company was under the microscope and being raked over the coals. And here you see it. The company dropped from 34 and change all the way down to $2.10, and it's bounced back into that $8 to $9 range. So again, it's bounced back quite a bit so far, but it's not even back to these lows back during the period of more normal operation. And again, when you look down here, Value Line is keeping up fairly well with other analysts that follow the company, but these numbers that you see here for 2013 and 14, and then all the way out to 2017, have actually improved rather dramatically. One of the other things we wanted to show you tonight is if you go to the home page at Manifest, you can see a little bit more about this story. In fact, we'll probably put some of the stuff that Ken was talking about a few minutes ago, and perhaps some of the other stuff, right here in the featured posts area. But if you go to last week's update at Manifest Investing, we actually included some discussion of Bell Canada and Inteliquent. You can actually go take a look at some of what we had to say there. But this is where we keep our update of companies as we do the batch update every week and updating fundamentals. So again, go back to the home page and click through. Today's update is right here under This Week at Manifest for the companies that are being looked at this week. Not quite as many of interest this week, but might be worth a look. So I'm going to go ahead and add Inteliquent to the tracking portfolio. May come back with some thoughts on that as we watch it more carefully, but again, I think there's room for price recovery here in what appears to be a viable company.
Well, Mark, let's see if our audience has a choice. I'm going to launch the poll. It looks like I had my monkey do the typing tonight, however, so please please bear with the typing errors. This should be IQNT, not the way I typed it. And this is Neustar. Did I have the right ticker for Neustar, NR, Mark?
NSR. Close enough, as long as everybody knows what they're voting
okay.
for. But
we have Inteliquent, Credit Acceptance, and Neustar, or none of the above. If you take a moment to give us a vote, we'd appreciate it. All you have to do is take your mouse and choose one of the four choices. We'd love to have about 80% of you voting. We're up to about 65% right now voting. So if you just take a moment and click one of those.
I think he is getting a few more votes this month.
Could I convince folks to a couple more? There we go. We just went over 80%. Let's leave it open about 10 more seconds. We have quite a few folks out there tonight. I'm really pleased that we attracted a Monday night audience. It's our biggest Monday night audience ever. We're happy to have you here tonight. And I'm going to close this poll down at 87% voting. And let's share the results with everybody.
Oh, thanks, everybody.
And folks
No
like
faith.
Credit Acceptance at 55%, Neustar at 22%, Inteliquent at 8%. And
I demand a recount. If
50. It's been recounted,
ticker
son.
was right. If the ticker was correct, Neustar would have won. They were confused.
And,
I second that motion,
15%
Si.
saying none of the above. Well, next time I let you guys do the typing. So, Mark, I'll turn it back to you here. And let's see, I have to hide the poll to make this work. Your screen should go back up again. There you go.
Okay. Well, I think with that, we're just going to go ahead and say thanks, everybody. Thanks, Ken, Si, and Hugh, for your contributions. We'll go ahead and stick around for a few minutes and answer questions. We're only 1 hour in, so we typically leave time for questions, and it's good to have some time. So with that, I'll just say thanks to all of you and to the audience, and we'll stick around for some questions for a few minutes.